Talk some trading. Phil Streible back with us from Blue Line Futures, Chief Market Strategist. Phil, welcome back. The big move, of course, one you were looking for was a pop in BTC. We got it. We're so close. Only a matter of time till a record.
So we go back up. No, so we go to 100,000. Forget 70,000, 69,000. I think we're breaking out to the upside. Look, 93% of all the Bitcoin supply has already been mined and is circulating. We've got a 4-year cycle coming up of the halving, which is another bullish catalyst.
Come on, you're a halving, dude. Isn't that the whole point of buying Bitcoin? Isn't that priced in from the moment? The whole point is to watch the halving.
It's not more supply, it's more demand. Wait. Here, forget everything. All I need to do is tell you one thing. There is more volume on crypto ETFs being traded right now than SPY and QQQ.
Yeah, I hear that.
If that doesn't tell you that's where the party's at. That's where you got to be.
Well, how come the other coins have kept up equally? The market cap dominance of Bitcoin's unched since the ETFs. I mean, it seems like they're buying everything.
Well, I'll tell you this. You take the average crypto return over the past 6 months for the top 200 coins, and it's 154%.
Sure.
It's pick your poison when it comes to that. So the options, they're not available yet on the ETFs. Wait till we start getting these gamma squeezes and talking about zero DTE, Bitcoin ETFs. That's when it's going to be the explosion.
That's like a Wild West times 1,000. True. I mean, look, there's no options on them yet. I was looking for them earlier this week. Probably saved me some money that they weren't available yet. All right, so what's in the timeline for this? To your point, the whole crypto community loves this big halving event. Again, I think that's like the whole point of Bitcoin's existence. So, you kind of buy it because of it. I'm not sure. It's like buying Apple and they get an iPhone report, like that's expected. They got to sell iPhones. It's got to have.
Well, all we're seeing is that less supply is going to be put on by the market, right?
Sure.
You're gifted these Bitcoins, but it's half as much and it keeps getting quartered down like that. But the demand is really picking up. We saw 2 more financial institutions are allowing access to ETFs. Like if you were going through Bank of America, Merrill Lynch, something like that, you tried to go on there, buy like the IBIT ETF, it's going to tell you it's not available. So there's a lot of financial institutions that just haven't allowed trading in it yet. And I think that that's where you really get more of that retail client becoming involved with that. And also the financial advisors, the wealth advisors, I don't think they've modeled it really into any of their asset allocation models. So once you get that going, it's just going to become more broad based on people and the ownership with it. And that's where prices gradually rise. Now, I'm going to tell you, we did remove took off some of those futures contracts today, right around 64,000. That matched yesterday where we had that big breakdown. Where we're looking at re-entering is kind of a bracket strategy. So if it breaks out back above 64,600, we want to be involved with the contracts. You use a buy stop above there, and then you look at about 60,000. That's where your limit order is on the downside. So we're really playing. If it breaks down, we want to be involved. If it breaks out to the upside, we don't want to miss the party.
Got it. Okay, makes sense. I mean, usually when Bitcoin makes a new high, it takes off from there. I do remember what it was October, the last record, right, when it hit 69K. That one was kind of interesting because it had just made the high around 65 a few months before. It dipped, came back, and then it did make that record, and then it fizzled out for like a year. So the last time we had a new high, it didn't go ballistic. Does that worry you at all that maybe this time we just get rejected at a high?
I mean, the time's a little bit different. I mean, we've got a different dynamic in the markets. I mean, you're seeing like NVIDIA breaking out, $100 move in that. You're seeing, that super micro computer. You got people going to that. People are really chasing assets again. And I think it's a little bit healthier dynamic in the market. I mean, we know we're going to have a soft landing. We know the economy is doing good. People are spending money. I think, like I said, I really believe that we're in a firm footing in the market. If we did get a Fed interest rate cut, that would be a tailwind. It's not necessarily taking off assets that are going to cause another uproar in inflation. We're not seeing $85, $90 crude oil. We're seeing natural gas prices below $2. All your grain futures are, those things are in the dumps right now. So
True.
Things aren't really taking off. Silver is at some, pretty historically low levels again in the 22. So a lot of these input costs and things are not dramatically going up. So I think that this is a healthy run we have on the markets. And I think that things like tech and crypto and stuff, they've got a place, and this is just now their time to shine again.
It seemed like Bitcoin was ushering in this turn to a frothier run-up of some of the higher risk assets. To me, that meant we should be watching the Russell, but today again we fall short of 2100. What's up with these small caps? Should we care?
The Russell, though, that's a tough one because it's still probably like 20% from its all-time high. So technically, if you're going to go to that, you're going to say it's a bear market. But if you look at the chart pattern, it looks like it's got this nice saucer shape going to the upside. I am concerned about regional banks, the commercial real estate sector. We did see a couple banks were showing some cracks that got swept underneath the rug. The Russell is the one, like if you were going to be like long NASDAQ, long this tech stuff, that would be your hedge to put in place, is to be short some of those small caps, because if you get the higher rates for a longer period of time, those companies are going to struggle. A lot of their financing is through debt. Higher debt causes problems.
True. Hey, last one, gold meandering after hitting that record. That was like the weakest record ever hit in anything. It like touched it for a minute and then it just stopped.
Yeah, it was on a Sunday night, too. That's why I got him a future trading account. So timing, pace, and depth of the interest rate cuts are key. We did get a breakout to the upside over the 50-day moving average, 2052. We got to get up over 2056. That's your trend reversal point. We could break out to the upside. I don't like the dollar index. It broke out. There's a downward sell-off, and we took back off, and we're at 104 on the dollar. So we saw gold bleed off again here today. So gold, not that great at the moment. You're going to need some more work to go. It's going to have its time to shine. Remember that from the first interest rate cut going back to 1990, we've done a study, rallies about 6% on average within the first 30 days of that cut. So you're going to want to be positioned in it. I think it has a place in a portfolio, and above 2,000, I believe central banks are holding, they're continuing to add to it.
All right. Great stuff, Phil. Always fun. Appreciate the chat.
Thank you.
Thank you, Phil Streible, Chief Market Strategist of Blue Line Futures. All right, let's get it.